We would say that the jar is 50% full or 50% empty if you are a pessimist. Obviously, we want to make sure that we know what the value of the property is. What is its capacity? Because could I fit 2 quarts of water into this jar? No, if I did, it would be a hot mess. If my water represented a loan on a real estate deal and my quart jar equaled the total value of the asset, this would be at a 50% loan to value. Hello and welcome to Nursing Real Wealth. I hope you're all doing well. I wanted to touch base with you about something a little bit different this week. For the last couple of weeks, I've been extremely busy with my new partnership with Eric Fuller, which has been phenomenal. We've had a ton of deal flow coming in and a lot to underwrite and work through and a lot of systems to get up and running and functionality. And so we got a little off schedule with the podcast, but we're getting back on schedule here. And I want to take a little bit of time and actually address some things, some topics that I found are common errors with borrowers or misconceptions. And so it's something I want to touch on over the next few weeks. We'll touch on a few key points that impact lending, impact requesting private capital, and making sure that everything lines up properly to work out to be a win-win situation. Rather than have win-lose or lose-lose scenarios. So for the next couple of weeks, I'm going to be pivoting just a little bit and targeting a couple of short educational topics. These will be slightly shorter episodes than I usually do. But this week's topic is loan to value, or LTV, as you hear a lot. The first, I just want to break down what is loan to value. Or LTV. You're going to hear me use LTV a lot. I'm going to cover it in 3 main points. So what is loan to value? How do you calculate it properly? And why does it matter, particularly for private money lenders? So loan to value is a financial term that's used by lenders to express the ratio of loan to the value of the asset in its present condition, not in its future condition, past, optimal condition, optimized condition. No. What is it worth today? I don't care what it will be worth in 6 months when I'm talking about loan to value, okay? I'm talking about loan to its current value today. So in simple terms, it's a way to measure how much are you borrowing against the values, the capacity of the value of the property. Loan to value is expressed as a percentage to indicate what percentage of the property's value is being leveraged by the loan. And I always like to express loan to value by illustrating the ratio of water to the capacity of my drinking apparatus here, quart jar. And if you look at this, well, drink it down a little bit here, and we're sitting at, that's about halfway up, right? So we're sitting at about the 50% mark. And we would say that the jar is 50% full or 50% empty if you are a pessimist. We could also say that there is a 50% water to capacity ratio if we wanted to get real hoity-toity here, okay? But if my water represented a loan on a real estate deal and my quart jar equaled the total value of the asset, this would be at a 50% loan to value, right? Okay. Obviously, we want to make sure that we know how much loan to value. We want to know what the value of the property is. What is its capacity? Because could I fit 2 quarts of water into this jar? No, if I did, it would be a hot mess. So a loan of $70,000. So how do we calculate loan to value? I want to move on to this idea here. So a loan of 70% or of $70,000 against a property that's worth $100,000 is going to be 70% loan to value. The easiest way to determine the loan to value is to take the loan and divide it by the value of the home. This is going to spit out a decimal for you, and then you're going to want to multiply that decimal by 100, or you could just move the decimal point over two places to the right to get your percentage. So $70,000 divided by $100,000 is going to spit out 0.7, and 0.7 times 100 equals 70, and that's 70%. This is a very safe loan at 70% loan to value. If you have all of the proper security documents set in place and the liens recorded against the property, it's safe because if the borrower defaults on that loan, you have a safe margin of 30% to foreclose, to fire sale the property, and to not only recuperate your principal of your loan, but also most of your profit and then fees to cover the cost of foreclosure. It's equally important to find out the loan's combined loan to value when there is a first position loan and a second position loan. And by the way, I would never get into a third position loan. That's just me. Maybe somebody's got a high risk tolerance, but I think that's stupid to get into any kind of loan that's got a third position on it. That's a whole nother topic for another day. But this is expressed, this combination of first position and second position and how they are ratioed up against the value. This is expressed as combined loan to value, or CLTV. And so let's say that on the same property as an acquisition by a buy and hold investor, they have taken over the property with a sub 2 transaction, right? And so there's a first position loan of $70,000. And they're asking for a gap fund of $40,000 to cover closing costs and to pay themselves an acquisition fee. To figure out the CLTV, you're going to need to add the $70,000 plus the $40,000, which equals $110,000. Yay. And then you will divide $110,000 by $100,000. And that will get you 1.1, and 1.1 times 100 equals 110% CLTV. Do you think that this loan is a safe loan, or is this a hot mess? There you go. I think you're onto it. There are a few ways that you can lend on these and potentially be okay, but I don't like these kinds of loans because they're high risk with a low profit margin. And just a super high risk loan with a high potential for failure and really a low yield for profit. If you're happy with a 12% annualized return, great. But it's a 12% return with not a lot of backing, right? So you can throw a lien on this property, but if you have to try and collect on this lien, you're going to try and collect $110,000 against a property that's worth $100,000. Not going to work. So you can see that it's very important. This is why loan to value is one of the most critical metrics to assess the risk profile of your loan. A lower loan to value ratio means there's a larger equity cushion, which means that the loan is less risky for the lender, and frankly, less risky for the borrower. This is a crucial metric to assess for private money lenders, as it provides a measure of security. But in order to be able to assess loan to value, you also need to be able to accurately gauge what is the as-is value of the property. Now, this is a whole nother skill and a whole nother topic that I'll be talking about in another episode, so we aren't going to get into that today. But in this case, we only, in our case as lenders, at Creative Cash Partners, we only lend up to a 70% loan to value in first position and up to a 65% loan to value in second position. So this means properties needing a second position debt will often require a cross-collateral property to bring that total loan to value down to 65%. So in the example that we just talked about, right, this acquisition of a $100,000 property with $110,000 worth of debt, you could make this loan a lot safer for you as a lender if you would utilize cross-collateralization in another property from the borrower's portfolio. So for instance, If the borrower wanted to have you come up with the gap funding for this property and fund those closing costs and their acquisition fee to pay themselves for the time that they spent working on this, you have to have another asset that has significant equity in order to do that. So you would need to put a lien on maybe a free and clear property or even a property with a second position debt that's very, very, very low. So let's just say that they do have a second property. Okay, they've got a second property worth $400,000 in as-is condition. Okay, we've proven that it's valuable to $400,000 on the market today. We could sell it for that today. And they have a first position mortgage on this property with a remaining debt of $100,000. So if we add a second position loan of $40,000 to this loan, the combined loans would be $140,000, and the LTV would be $140,000 divided by 400, right? That spits out 0.35. 0.35 times 100, that's 35% loan to value. So they could use the equity in one property to properly secure your loan to pay for the entry fee for another property. And this would be a much safer loan than if the loan was secured against a property with only $100,000 worth of value. This would be a simple way to decrease your risk as a lender on the loan. That would likely be around 12% annualized. Now, we use this strategy all the time to provide short-term loans at Creative Cash Partners, the partnership that I work with. So me and my partner, Eric Fuller. And I'll give the caveat that we do not fund these types of longer-term loans for buy and holds, just because there's typically not an opportunity for a high-yield return. My partner and I fund high-octane loans that have a significant chance of high-yield returns with high levels of security. So applying these principles, we will leverage the equity of assets to help borrowers become cash buyers when time is of the essence. So if you have a property with significant value and you have an opportunity to purchase a property cash, you can come to us for short-term capital to secure the deal and then refinance yourself out of the debt. Imagine this scenario. So you come across a property that in its as-is condition is worth today, it could sell today for $300,000 on the market. And the seller's distressed. They're in foreclosure or whatever other reason, and they want to get rid of this property, and they've got 5 days, or it's no dice. And they're willing to let this thing go for $200,000, but you gotta close it in 5 days or no deal. So because the property is in distress and you got to get this done quickly, if you don't have $200,000 to cough up quickly and get this property locked up, you're not going to be able to get traditional financing. You're not going to get bank financing. You're not going to be able to refinance a property to be able to get that financed. So you can come to us. We'll give you a loan for $200,000, which is a very safe loan. It's only at 67% loan to value in first position. And then you could refinance us out of the debt position in 3, maybe 4 months, and we'll charge a flat fee. We'll charge a flat fee of 15% for, say, that 3-month mark, or 20% for the 4-month mark, depending on the length of loan, right? And so that'll be a fee that ranges anywhere from $30,000 to $40,000. Now you might be saying to yourself, well, that's a really expensive loan, but actually think about it. You just got a $300,000 home for between $230,000 or $240,000. That's still going to work with the typical 80% cash out refinance, leaving you a 20 to 30% equity stake in the home for the price of closing costs. So was it really that expensive, or was it just a good creative deal? So that's just a quick primer on loan to value ratios and why they matter so much in real estate investing, and particularly in private money lending. So understanding loan to value can really help you make more informed decisions and ensure that the security of your investments is there. that you're not just lending off of the behavioral patterns of your operator, but that you are lending based off of real backup plans that you're going to be able to enact if something goes down the dirty slope. So hopefully this has been helpful. Thank you for tuning in today. If you enjoyed this episode, please like and subscribe to our YouTube channel. We'd love to hear your feedback in the comments below. Be sure to ask any questions. If you've got any questions about this, shoot them in the comments below. Happy to go and respond to those in another future episode. But join us every other Tuesday for more insightful discussions on nursing real wealth. Have a great day, and God bless.